Ever wonder what happens in the market microseconds before a real reversal? This breakdown looks at liquidity stress exhaustion, a quantitative framework for identifying when aggressive order flow starts to outpace available liquidity, often a precursor to short-term structural shifts. At the core of this tool is an illiquidity ratio, calculated by dividing true range by volume and applying a logarithmic transform to normalize the distribution. That raw value is then converted into a z-score using a rolling mean and standard deviation, giving a statistically grounded measure of how stressed current price action is relative to its own recent history. When that z-score crosses above a configurable sigma threshold, combined with directional confirmation from an EMA-based trend filter, the system flags a state of potential seller or buyer exhaustion. To reduce noise, the framework layers in optional confirmation filters. A Pearson correlation coefficient, derived from a custom least squares regression engine, measures how well price is tracking a defined linear trend, filtering out choppy, low-conviction moves. An optional ADX filter can further restrict signals to periods of established directional strength. For traders who prefer smooth price inputs, the tool offers a choice between a custom Kalman filter and an LAMA, linear lag adaptive moving average, adaptive filter, both applied before the trend calculation. Once a stress condition is confirmed, the indicator automatically maps out a full risk framework anchored to average true range. This includes a volatility-adjusted stop-loss and three-tiered take-profit levels expressed as R multiples, visualized directly on the chart with dynamic lines, fill zones, and labels. A built-in regression channel, complete with inner and outer deviation bands, adds additional context on the current price structure, while a real-time dashboard consolidates trend regime, filter status, and key statistical readings into a single view. This is a deep dive into the math and mechanics behind a systematic approach to identifying liquidity-driven exhaustion points, not a signal service, but a lens for understanding market microstructure. What you'll learn in this breakdown asterisk. How to construct a normalized illiquidity ratio from true range and volume, and why the log transform matters for distribution stability. How z-score normalization turns a raw statistical measure into an interpretable stress signal. The mechanics of a custom least squares regression engine, including how Pearson's R is used to filter for trend conviction. How Kalman and LAMA adaptive filters smooth price data differently than a standard moving average. How an ATR-based R multiple framework structures risk and reward levels around a statistical trigger. Why combining volatility, correlation, and trend regime filters can help reduce false signals in a systematic framework. Warning: educational software for analytical purposes only. Trading involves significant risk.